The Bank of Canada makes its next interest rate announcement on Wednesday. Currency traders are putting their bets in. Anyone in the market for a mortgage, they're waiting with bated breath. But Canada's biggest banks, they're already raising their rates. RBC got the ball rolling when it hiked its posted 5-year fixed rate Thursday. The mortgage moved from 4.99% to 5.14%. TD did the same. It's the first time its fixed rate has been above 5% since 2014. Fixed-rate mortgages are pegged to the bond market. A strengthening economy has pushed yields higher, which, as we've seen, pushed fixed-rate mortgages higher as well. Enough moves like this will also eventually raise the rate the Bank of Canada uses for its stress tests, which means a lot of home buyers will no longer qualify for a mortgage of the same size. Joining us now to talk about the impact of all these changes, Marcus Tzaferis, founder of MorCan Financial. It's nice to see you back on the show. Thanks for coming in.
Thanks for having me.
My first question is, okay, fixed rates have gone. Are variable rate mortgages next?
So that will depend on what the Bank of Canada decides to do.
So they'll
next
wait
week.
on that, you think? Yeah,
of course, yeah.
But, I mean, we are clearly now into a scenario and an environment where it's not just ethereal, it's not just a thought concept. Mortgage rates are going up.
Yeah, and the impact of those rates going up aren't just on what people are paying, it's what they're qualifying for. So because these banks have now introduced, a 15 basis point increase, it's going to really speak to the affordability of Canadians when they're qualifying for those mortgages now.
Well, and you sort of take in the stress test that also says you've got to now test at however many points above what the sort of Bank of Canada's average is. Now we have two banks moving. That average is going to go up. So all these people are now going to have to qualify under the new rules as of January 1st at a higher rate mortgage. We're going to see people that are priced out of the market faster and harder than they were even just a week ago.
We're already seeing it. I mean, as of January 1st, they implemented the rule that everyone had to qualify at that Bank of Canada prescribed rate or 2 percentage points above. Now we're seeing a 15 basis point increase. I doubt that will not be followed by the rest of the Canadian banks, which will definitely result in the Bank of Canada saying that the new litmus test to qualify for a mortgage is at 5.14 now, right?
What is your sense with the fixed rate? They move now, then we have on Wednesday the Bank of Canada will make its move. Do you expect the banks will tack on an extra couple percentages after that, or is this sort of a locked-in rate pricing in the expectation of a Bank of Canada?
It's a great question. I mean, it comes down to how our economy is performing. We've got over 100 months of a growing economy. If you look back 100 years, this has happened 3 times. So at some point, the economy will slow. The Bank of Canada introducing the brakes to our economy by increasing rates is a way to slow that economy down. And the 5-year fixed rate that we saw increase from Royal and TD is just a response to what they're seeing in bond markets. So people are seeing that the market looks like it's getting hot, and they're putting in 15 basis points cushion for themselves because the cost of their money to fund these mortgages is increasing.
We see so much of economic activity in Canada tied to the housing market. We saw, as those policy initiatives were put in place last year, the foreign buyers tax, the empty homes tax in Vancouver, these various things to try to cool down the market. It cooled the market, and then they started to bounce right back up again. Where do you expect the market to go in the next sort of 3 to 6 months as we now begin to see the reality of a higher interest rate environment settle in?
It's a tough question. I think because we don't gather enough information on foreign home buyers, it's hard to quantify what these moves are going to have on the market as a whole. And we're still seeing a frenzy over purchasing. It's just moved. First, it was in detached and semi-detached homes, and now that qualifying is becoming more difficult, it's streaming into condos. So we're going to see the real estate market continue to perform well, and we won't know when that will stop unless we start really properly gauging the factors that are influencing it.
We also just don't have a lot of people that have experience in an environment where interest rates are on the rise. I mean, I know people that own a home that have renegotiated a mortgage twice and have never really known those rates to be on the rise. It's been so long that they've been at these emergency low levels. How does that impact the market and our ability to figure out what comes next?
Psychologically, what are the consumers prepared for? And I think that's what we're seeing the Bank of Canada introduce to us right now. The one caution I would put on, saying that, the Bank of Canada will continue to increase rates indefinitely and bond yields are going to continue to spike up is we still have to pay attention that there's a lot of factors influencing our economy to the negative.
Right.
We still have a massive question mark with NAFTA. We've got, the Canadian dollar, which is so susceptible to these types of moves that can really affect our GDP. And again, we don't quantify how much of our GDP is reliant on housing.
And there's a lot of unknowns tied up in
I don't know if we're going to see a massive run-up in rates. And I think, again, we're in 100 months of expansion. Typically, when that ends, we're not going to see the Bank of Canada increasing rates. We're not going to see bond yields spiking. Right. So if we're in a new type of environment where rates are a little bit lower, that's okay too.
Indeed. We've got to leave it there. Marcus, great to see you again.
Yeah,
thanks for this.
Thanks.
Marcus Tzaferis, founder of MorCan Financial.